All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Friday, everybody. Today is August 22nd, 2025. And the top story this morning, the market sits in anticipation, waiting with bated breath for Jerome Powell to give them exactly what they want at the Jackson Hole Symposium, which is set to begin at just 10 a.m. Eastern Time, just in a few hours here. Powell will take the mic and tell everybody what his plan is. What's he going to do with this unelected bureaucrat who has immeasurable power over the value of the world's reserve currency? He's going to give a speech, and, well, a lot of money is going to start moving one direction or another based on what he says. So let's set the table for this speech, all right? If you've been following this channel for a while, you've probably been keeping up with these developments. But the big question, will he be a dove? Will he come out and say rate cuts, easy money, or will he be a hawk and say, oh, based on the totality of incoming data, our current stance is appropriate and we will adopt a wait-and-see approach? So what's really going on? The big one here, the monkey wrench that has been thrown into the works of what was previously viewed as a guarantee of a rate cut was last Friday's producer price index. When that PPI came out sharply higher than a month ago, a lot of people said, whoa, that's tariff inflation waiting to work its way through the system. Maybe rate cuts are a bad idea. And that's kind of what triggered this sell-off in tech that started at the beginning of this week. It's taking a little bit of a breather this morning here. That combined with a recent parade of headlines talking about an AI bubble bursting, something that's just gaining steam as we go here. But it was really that PPI that set in motion the events this week. So that's the big reason. How can you justify a rate cut when you have this big question mark of producer inflation and the question of will it filter through to consumers? And by the way, we've got some articles later on in the show that are going to tell you that's not so cut and dry that that's going to happen. I know there's a lot of people out there who are, leaning on the academics of it all, saying obviously those costs are going to be passed on to consumers, but it's not just coming down to academically. Some people are going to be like, well, I'll eat the margins and try to gain market share. And you actually see a lot of that. And the people who are doing that are being rewarded right now. It's worth keeping an eye on that. But it's that PPI. That's the big question here. That's the one that's going to make Powell want to wait. Now, you've also got the non-farm payrolls that came out a few weeks ago. You guys remember that jobs report? Remember the massive downward revisions? And then they fired the head of the Bureau of Labor Statistics? Well, that's a data point that says, cut, hurry up and cut. The job market is weak. All right, so that's leaning towards dovish. But then you've got CPI that has now been, 4.5 years above their arbitrary 2% target? CPI, maybe it's not like running up at an alarming rate, but it's still close to 3%. It's still too high. It's still causing people to be priced out of the housing market, and people are going broke because they can just barely afford power and rent and utilities and food. So CPI says, no, wait, inflation is still too high. But then you've got President Trump, who is screaming for a cut. As a matter of fact, President Trump came out, there's an announcement from the White House that there will be a major announcement at noon today. Now, what does that mean? That could mean anything when the White House says a major announcement, but I can't help but think that announcement at noon, whatever it's going to be, is meant to somehow steal the thunder from whatever Jerome Powell does at 10. Because that announcement is going to come right as Powell wraps up his speech at Jackson Hole. All right. Now, the Trump screaming for cuts, that's pretty interesting because, number one, the Fed independence, right? Fed independence says, no, don't cut because we can't cut because the president wants to cut. And, well, there's some truth to that. The Fed should be an independent body. If you must have a Fed, it shouldn't be at the whims of a president who is always going to want easy money to flow to make his economy look stronger. But at the same time, if the Fed cuts right now, they'll be viewed as acquiescing to President Trump, when really all the people that are gathering in Jackson Hole, this gaggle of international central bankers and powerful elitists, they all want to stand together for a photo opportunity and give the middle finger to Donald Trump. So that says maybe they won't cut. Can you see how we're just going around back in circles here? And look, guys, we are pawns on this chessboard being pushed and shoved around as these elites jockey for power and make these stupid statements back and forth at each other It's our lives that are being messed with. It's not supposed to work that way. And that's why I overuse this hashtag and the Fed over and over and over again, because it's just not supposed to work that way. By the way, with all of this being said, all of these reasons to cut or reasons not to cut, we've got a money supply that has continued to grow unchecked, even as the Fed has claimed policy has been restricted. That growth in the money supply is highly inflationary. All right. And at the same time, after that PPI read on Friday, we've had a big shift in expectations. We'll look at the CME's Fed Watch tool in a little bit here. Before PPI came out last week, it was like 99-1 that the Fed was going to cut at this September meeting coming up. It was like 99-1. And that you actually had a pretty good, the 1% chance was that he cuts twice. Now we're looking at 70-30. 70% he cuts, 30% he makes no cuts at all. And we've watched that get more and more leaning towards no decision by the Fed, towards not cutting in September. We've still got a couple of weeks here. We've got another non-farm payrolls. We've got another CPI, another PPI, the annual benchmark revisions. There's so much data that comes out between now and September. The market is kind of already priced in the certainty of a rate cut. So a hawkish J. Powell could really rob the wind from the sales of stocks today. It's really worth keeping an eye on this, guys. And last thing about Trump's major announcement at noon, there is one thing that President Trump could do that could throw another monkey wrench into the works here. He could say, I don't like what Jay Powell's going to say at 10 o'clock. Too late, Jerome, all those stupid things. He may come out and he might say, I am going to nominate a shadow chair. I'm going to appoint Jerome Powell's replacement now. Now, that won't change the decision. But what it will do is it'll take all the press and all the market analysts and everybody will stop splitting hairs over Jerome Powell's inflection in his voice and every last little word, and did his gigantic bushy eyebrow rise a little bit when he said that, or didn't it, and move money based on that. Instead of all of that hyper focus on Powell, it will be, all right, well, what is this other guy coming in behind Powell going to do? What does he say? Let's pay more attention to him. It will basically undermine Jerome Powell's ability to jawbone markets. That's one thing that Trump could do right away today if he doesn't like what Powell is going to do. So we may see that shadow Fed chair be nominated today, or this major announcement from the White House, as Mish put it on our phone call this morning. Maybe he's just going to sell stakes. Maybe Trump stakes are making a comeback, and that's what this major announcement is going to be. I guess we're just going to have to wait until noon Eastern time to find out. All right, so now that the Fed talk is all behind us, let's talk a little bit about some of these other stories. We got a couple of NVIDIA stories going on this morning. NVIDIA has asked their suppliers to halt production of the H20. That's according to a report from the website The Information, which, by the way, Jim Cramer hates The Information, even though The Information has been freaking money in the bank for the last year or so. This website has been outstanding. And it makes sense that NVIDIA would ask to halt the H20 production. Recall that article we talked about yesterday that the Chinese threw a hissy fit when Commerce Secretary Lutnick said, we're not selling them our best or our second best. We're selling them our third best GPUs. And then the mighty dragon that is China got all offended and said, no, well, now we're not going to buy your GPUs. We're going to take our ball and go home. And so NVIDIA is saying, nope, let's halt the H20 production. Now, I don't think that's that big a deal for NVIDIA. They've already booked a $5.5 billion loss on the H20 because the government came out a few months ago and said, no, you can't sell the H20. And then Jensen Huang spent $1 million on a dinner at Mar-a-Lago and then promised to give the government 15% of revenue. And then they said, okay, you can sell the H20. And then the Chinese are like, no, we don't want your H20. So I don't think the loss has already been booked here. Maybe a little bit of enthusiasm on that 15% of revenue number. Maybe some of that now gets cooked off because of that. Maybe it pushes the stock down a little bit. But the other article going on this morning is that NVIDIA is already in negotiations with the government about the B20, basically the Blackwell version of the H20, the new version. I mean, the last one was a total loss, and they're already working on the next one. But again, it comes down to the whims of the government, which is known to change with the tides several times a day. So we'll see what goes on there. And of course, this is all leading up to next Wednesday, the 27th, when NVIDIA reports earnings, which I'm sure will be another magnificent revenue and earnings beat combined with growth in accounts receivable and all kinds of accounting gimmicks. But the question is, will that be enough to halt this sell-off in stocks, which, by the way, could gain steam, again, if Powell comes out like a hawk today. We've got two other interesting articles this morning. One about private equity that keeps inventing new ways to give cash to investors. In other words, they're coming up with new ways to generate fake profits at the expense of their next investors. First, it was continuation vehicles, where instead of selling their holdings, they just take their holdings from one fund and move it into another fund and call it something new and sell it a second time. When that stopped working, they created the continuation vehicles of the continuation vehicles. They took that fund, put it into a new fund. Those are called CV squares, selling the same thing a third time to a third batch of investors now. And of course, now that that's no longer working, now they're out there borrowing money against commitments to those continuation vehicles. Geez, guys, all the things that they will do to avoid price discovery. And isn't it comforting to know that this stuff is going to be sold into our 401ks? And coincidentally, even as that story is breaking this morning, we got another one talking about default warnings picking up in the private credit space. Again, private equity, that is small, privately held companies. Private credit is loans from non-banks to those companies. And a lot of times the private equity firms are the lenders of this private credit to their holding companies that they're moving around from fund to vehicle to vehicle to vehicle like a shell game. Well, the defaults are still very low in private credit. They're actually incredibly low. And that's not surprising because nobody has explained what a default even means in private credit because this is unregulated banking. They're not banks. They're not subject to any of the FDIC and all that other crap. So they can just say what they want. Still fighting that sore throat, guys. But look, all these different ways they're using payment in kind, all these different cockamamie things, loan extensions, extend and pretend, all these things they do to avoid using the word default. So we don't really know how high defaults are in the private credit space. And again, these are loans to the companies that nobody's able to sell in the private equity space. And ultimately, the destination for all of this garbage is your retirement. Pay attention to this private assets thing, guys. This is going to blow up someday, and it's going to be big. This could be as big as the commercial real estate bubble, which it continues to blow up itself. All right, we also got a couple of trade war. I know we're getting kind of long here. We got a couple of trade war headlines. Retailers, the ones that are not passing on the tariffs to customers, are being rewarded for it. We got Germany's GDP shrank by 0.3%. They are now in 3 years of recession over in Germany. And we've got a news of transshipment to avoid tariffs again this morning, except this time it's us doing it. Oh, I thought it was only the Chinese who do the transshipment thing. Nope, we do it too. Guys, we got a lot to talk about this morning. How about we shrink my big melon of a head? Let's see what's going on in the world of finance today. And oh, look, I didn't share my screen yet. I am remiss. Let's share my screen here. Where are we? There we go. Hey, by the way, do all that like and subscribe stuff that we're always asking you to do. So you can come back tomorrow and have your coffee with us because we do this every morning. Right now, the S&P 500 is higher by 17 points, roughly, about 0.25% to the upside. Again, market's just kind of sitting here waiting for Jay Powell to tell us what he wants to do. The Dow is up 165 points or 0.37%. Man, this sore throat is really a drag. And the NASDAQ is up by 36 points or 0.16%. So stocks are up a little bit across the board here. Again, just adopting a wait-and-see approach, much like our financial regulators. The dollar index, meanwhile, is a little bit lower. We are 5 basis points lower, 98.61 for the DXY, a slightly weaker dollar. Pay attention to the Dixie today, guys. We will see this chart move one direction or another based on what Jerome Powell comes out and says. And the bond market is also quiet. And look, at the end of the day, guys, it's the bond market that Jerome Powell answers to, or at least the people who are at the whims of the bond market. And that's the big question. And right now, the bond market is quiet. And the bond market is really ultimately what is going to be demanding rate cuts. And as long as the bond market stays quiet, then Powell has wiggle room to not cut here. The 30-year Treasury is at 4.906. That's lower by almost 2 basis points. The 10-year is at 4.309, lower by 2 points and change. The 2-year, 3.791, off by just a fraction of a point. And the 1 month is actually higher here by 3 basis points, 4.372. That move in the 1 month, that's kind of interesting. Maybe that's the bond market saying Powell's going to come out like a hawk today. Interesting development there. Looking over at the commodities market, we've got some red in metals. Again, that is suggesting a no cut. We've got spot gold, $3,326. That's off by $12 or 0.36% lower. Spot silver, $37.87. That's off by 28 cents or 0.75% lower, but I still like that shiny. Copper, meanwhile, is basically unchanged. Platinum down by about 1.4%. Palladium higher by 1.6%. And crude oil's going a whole bunch of nowhere, higher by 9 cents, $63.60 for October WTI futures. Bitcoin still having a rough week here, $112,200, off by about $280 from yesterday. This is as shown on Coinbase. Bitcoin gave up its 50-day moving average a couple of days ago, and we have continued to grind lower here. I would note, guys, this level we're at right now is the previous high that we saw from back in May. So will we find a little bit of support here or continue to grind lower? We're just going to have to wait for J-Pow. A dovish J-Pow would see Bitcoin rally. A hawkish J-Pow would probably see Bitcoin sell off a bit here. All right, now let's refresh the CME Group's Fed Watch tool, because this is the market telling us what it thinks J-Pow is going to do. Now, this is very interesting here, guys, where this is the odds of what the Fed funds rate will be come after the September meeting. And right now, the market is saying there's about a 69% likelihood that we are at 400 to 425. In other words, there's a roughly 70% chance that the Fed cuts. And there is a 30% and change chance that the Fed doesn't cut. So the market is still leaning towards dove here, but it's important to understand the change. A week ago, right before PPI came out, this was 99 to 1 that they cut. All right. And actually, it was 100% that they cut, because it was 99 that they cut once. It was 1% that they cut twice. No cut didn't even show up on the radar. Now we're 70-30. So the market is clearly trending back towards a neutral Fed here, still, though, with a lean towards cut. And we've got a lot of data points in the meantime. A weak jobs number could push that cut likelihood higher. A strong inflation print could push the no cut higher. And, you know, the Fed has their dual mandate. They're supposed to be adhering to or answerable to both inflation and employment. So they may have to pick between one or the other. I'm just not so convinced that they're definitely going to cut here. Again, if we get any kind of like developments in the bond market, any kind of liquidity crisis, I mean, reverse repo is getting pretty low. That could potentially cause some ructions in the bond market. It's possible. But right now, I don't see anything screaming, you got to cut here. Anything besides, you know, the idiots on CNBC who are constantly demanding more and more and more from the central bank with no regard for what it does to people in regular Main Street America. You know, other than them, they're the only ones who are screaming for cuts, along with President Trump, of course. And then we got this one from Unusual Whales, again, breaking: Trump to make a major announcement at noon today per the White House. You know, sometimes these major announcements are not so major. Sometimes they are. The timing, though, that they're going to do it at noon, that is right after the conclusion of the Jackson Hole speech. So it looks like Trump is setting up to steal some of J-Pow's thunder. And again, I get this little inkling in the back of my mind here that he's going to appoint a shadow chair, or at least nominate a shadow chair. Again, he can't fire him right away. Maybe he's going to try. Maybe he's going to come out and just call him too late Powell and call him names and stuff. But pay attention to that as well. That's a wild card in the day as well. All right, let's talk about NVIDIA. They asked their suppliers to halt H20 work. That is according to the information. There's Jensen in his stupid jacket. NVIDIA has instructed component suppliers, including Samsung and Amkor, to stop production related to the H20 AI chip, the information reported, citing unidentified sources. NVIDIA issued those orders this week after Beijing urged local companies to avoid using the H20, the information said, referring to a chip designed specifically for the Chinese market. The U.S. company shares slid about 1.3% in pre-market trading. Where are we coming down here? It's unclear whether the information story relates to new production of the H20 or stockpiles of unfinished AI accelerators. Now, that's kind of important there because they've already written off the stockpiles. If this is new H20s, then this could mean a bigger expense for NVIDIA. Semi-finished semiconductors are piling up at Amkor, which packages chips for customers like NVIDIA, the information reported. Representatives for Amkor didn't immediately respond to requests for comment after normal hours. A Samsung representative also declined to comment. NVIDIA, which wrote off $5.5 billion of H20 chips for China after the Trump administration decided to ban the product, is still sitting on unsold inventory, Huang said the U.S. reversal of that ban over the summer could help NVIDIA recover some, but not all of that write-down. All right, so that's the H20. No more work on the H20. The Chinese don't want them after months and months of back and forth with the government. But already the next China thing is being talked about. NVIDIA is in talks with the U.S. to sell a more advanced chip to China, Jensen Huang says. This one in CNBC this morning. NVIDIA is in talks with the U.S. government about shipping a new, more advanced chip to China, CEO Jensen Huang said on Friday. Earlier this week, Reuters reported the U.S. tech giant is developing a new AI chip for China, dubbed the B30A. That will be a more powerful than the H20, the only semiconductor NVIDIA is allowed to sell into the country at present. The U.S. has grown concerned in the past few years that advanced American chips could be used in Chinese military applications. Offering a new product to China for the data center, AI data centers, the follow-on to the H20, that's not our decision to make, said Jensen Huang. It's up to, of course, the United States government, and we are in dialogue with them. But it's too soon to know, said Jensen Huang, who's probably going to buy himself another $1 million dinner at Mar-a-Lago, see if he can grease those wheels, maybe 15% of revenue, see what we can do. The transactional nature of this administration certainly leaves the window open for NVIDIA to offer them something. So the H20's out. The B30A is maybe coming in to replace it. Right now, NVIDIA stock's down about 1% ahead of the opening bell, $173.09, hovering near all-time highs still, even after the sell-off this week. And again, all this is leading up to Wednesday's after the bell earnings report from NVIDIA. That is an event that always moves markets one way or another, typically higher. All right, let's talk about this one, guys. We need to keep an eye on this. I know I beat this drum, and maybe this is getting a little long in the tooth for some of you guys, but you got to watch out for this stuff. Private equity keeps inventing new ways to give cash to investors. And again, when you hear give cash to investors, I want you to think fake profits, because that's what that is. They're fake profits, and private equity keeps inventing new ways to fake profits. That's why this is such a big problem. Private equity firms keep ginning up new ways to get cash into the hands of investors as a deal drought extends into its third year. They've taken out loans against their portfolio companies. They've moved those that they couldn't or didn't want to sell into so-called continuation vehicles, an asset shuffling technique that allows them to hold investments for longer. They've even rolled some of those assets into yet another newfangled vehicle that's come to be known as the CV squared, or a continuation vehicle of a continuation vehicle. By the way, if you guys are getting Big Short sushi restaurant vibes here, you should. It's a CDO of a CDO. What? Oh, my God. Well, now there's more. Firms including Bain Capital, Leonard Green and Partners have started using commitments to continuation funds as collateral, giving them another way to borrow money. Oh, so we've got, this pension fund has promised to put $20 million into this continuation vehicle of a continuation vehicle. Well, now I can borrow against that $20 million and then give that money to some of my previous clients in order to fake profits. That's what they're doing here. Meanwhile, KKR and Goldman Sachs are pitching complex financing that will allow them to move private equity assets into special funds without crystallizing losses that typically come from selling such investments at a discount. All of the firms declined to comment. The tactics underscore the increasing use of financial engineering by an industry struggling to return cash to investors. Distributions as a percentage of net asset value tumbled to 11% last year from an average of 29% a decade earlier. And guys, look, this increasing use of financial engineering, we are seeing that in every corner of the economy. The AI bubble, we're seeing it in commercial real estate, we're seeing it in crypto, now we're seeing it in private equity. But wait, there's more. There's always more. Default warnings start to pile up in private credit market. Again, guys, they sound the same. Private equity, that is small, privately held companies that are not publicly traded like stocks. Private credit is loans from companies that are not banks, typically to those private equity holding companies. And in a lot of cases, the private equity fund is the lender to the companies within their own portfolio of companies. This is a just absolute CF waiting to happen. Warnings on defaults are starting to pile up in the $1.7 trillion private credit market, prompting at least some analysts to raise concerns about underappreciated risks in one of Wall Street's favorite money spinners. For years, losses have been contained by the fact that private credit firms have more room than any other investors to be patient with borrowers when times are tough. During the pandemic, direct lenders granted companies more time to pay their obligations, often by negotiating behind the scenes with private equity owners. But a number of analysts this month are holding up a light to underlying stress, including from the lenders themselves. That's interesting. Non-banks pretending to be banks are showing stress. I'm sure it's probably nothing. While there is no universal definition of what constitutes default in private credit, default rates for the market are currently in the 2 to 3% range. Well, that's actually very low. If so-called non-accrual loans, those on which lenders expect to book losses, are added to the mix, however, that rate climbs to 5.4%, according to JP Morgan. That report that's based on data from KBRA DLD. The adjustment puts the default rate for private credit broadly in line with that observed in the broadly syndicated loan market. Private companies and their lenders have been able to keep payment defaults at bay through payment-in-kind arrangements that allow borrowers to defer cash interest payments until debt comes due, leaving them with one big bill at the end. Another way is by setting covenants at generous levels that make it hard to act on early signs of weakness, according to S&P Global analyst Zain Bukhari. A major selling point of private credit is the low default rates, Bukhari wrote in a report this month. But this reputation hinges on a narrow definition of default. Remember how we defined our way out of a recession in 2022? Well, now we can just define our way out of a default. Nobody's paying us back, but it's okay. It's not a default because I am in charge of deciding what a default is or isn't. If actions such as maturity extensions and conversions of interest payments from cash to payment in kind, so-called selective defaults, are added to the calculation, the rate at which borrowers are failing to meet debt obligations is much higher, according to S&P. Defaults may have been disguised by significant amendment activity. In other words, they're lying, as lenders can tweak credit arrangements to forestall defaults, according to a report this month by valuation firm Lincoln International. Guys, the floor is price discovery. I could read on and on about the dirtbaggery that is going on in private equity and private lending space. Trust me, something's going to blow here. All right. But it's not going to blow until after they park it in your 401k. All right. Meanwhile, we've got a couple of trade war stories this morning. This one's kind of interesting, and it does a pretty good job of summarizing some of the retail earnings that we've gotten over the past couple of weeks. The biggest retailers are thriving in the tariff economy. Walmart, Amazon, and TJ Maxx are beating rivals by offering deals to stressed out consumers. In other words, the ones that are not raising prices over tariffs are being rewarded. In the tariff economy, retailers who cater to cautious consumers are winning. Those who don't are falling behind. Walmart, Amazon, and the owner of TJ Maxx are scooping up market share from rivals by offering shoppers good deals and convenience. In a bid to ease the burden on stressed out consumers and undercut competitors, Walmart has kept price increases to a minimum by absorbing much of the tariff cost. We're keeping our prices as low as we can for as long as we can, Walmart CEO Doug McMillon said on Thursday. TJ Maxx is seizing the moment by snapping up excess inventory that other retailers ordered ahead of tariffs and now need to unload. Its CEO called the buying opportunities outstanding. Amazon made improvements to its delivery network that helped get packages to customers faster and more cheaply. That helped propel a whopping 11% increase in online store sales in the latest quarter. Amazon, so far, tariffs haven't made a big impact on its prices, the e-commerce giant said. Walmart is beating out rivals like Target in part because of its low prices and in part because of its large share of its sales are groceries, an essential purchase even for cash-strapped shoppers. Tariffs related to price increases are prompting more middle and low-income shoppers to focus on needs over wants. Walmart executives said on Thursday, because of tariffs, Walmart is raising prices on about 10% of the goods it imports to the U.S., absorbing the rest at the elevated cost. So, guys, this article kind of feeds into that whole big question of the higher than expected PPI last week, and will that filter through into CPI, and will consumer price inflation get worse because of tariffs? All right, it's going to get at least a little worse. Some people are going to raise prices. We know that for a fact. Others, it's not so cut and dry. And right now, the market is rewarding the ones who don't pass off at least all of that cost on the consumers. Walmart did say they're raising the prices on some things, 10% of their imports. but the rest, they're eating it in margins. And this is the big question here. Can the consumer even afford it? If the tariffs do just get passed right on to the consumer and they just raise the prices, the consumer ain't going to buy it because the consumer's already broke. And so the companies that can afford to eat that in their margins, they will eat it and they'll gain market share. The companies that can't afford to do it will raise their prices and they'll go out of business. And of course, that going out of business, that is why tariffs could actually backfire and turn into a deflationary impulse. Because if we start to see job losses because of retailers and companies going out of business, well, those job losses means consumers have less to spend, which means less demand, which actually means prices eventually come down over this. This is one big, giant question mark. Nobody really knows the answer here. People can hypothesize and they can posit and they can opine, but we just won't know for a couple of months here. And Jerome Powell's got to look at this whole mess and say, cut or no cut. It's not so cut and dry what he does. Meanwhile, the German economy shrank 0.3% in the second quarter as U.S. tariffs slowed exports. Things just keep getting worse in Germany here. The economy shrank by 0.3% in the second quarter compared with the first 3 months of the year as demand from its top trading partner, the United States, slowed following months of buying ahead in anticipation of U.S. tariffs. So tariffs are taking a chunk out of the German economy. See also deflationary impulses of tariffs. The Statistics Office revised on Friday its preliminary reading of a 0.1% contraction, further dimming expectations of a sustained recovery by Europe's biggest economy this year. It looks increasingly unlikely that any substantial recovery will materialize before 2026, said Carsten Bresky, global head of macro at ING. Germany was the only member of the G7 advanced economies that failed to grow for the last 2 years, and trade tensions could put it on track for a third year of recession for the first time in post-war German history. Yikes. And look, quiet part out loud, besides the tariffs, Germany is paying the price for its ridiculous, obscenely stupid energy policy. All right? A few years ago, the Germans put a 16-year-old girl with a sailboat and a publicist in charge of energy policy for one of the world's most modern economies. And in hindsight, that was a bad decision. Shocker, I know. Germany's got no power, and then the Russians invaded Ukraine, and Europe says we're not going to buy any Russian natural gas. Power got even more expensive. Not so good for factories and industry. So threatening to go into 3 years of recession here and no end in sight for the Germans. And last but not least, this was an interesting story because, look, we bashed the Chinese a lot on this channel, which is appropriate for the most grotesque violator of human rights in the history of the freaking civilized world. China is an oppressive communist regime. There's plenty to dislike about them. But let's keep it fair here, right? We bash them for transshipments, for shipping goods to one country to avoid tariffs, and then from that country they ship on to their final destination. Well, it turns out we do it too, and we do it with our garbage. U.S. scrap copper traders redirect metal to sidestep China levies. Well, sucks. How do you like it? Some U.S. metal dealers are redirecting China-bound shipments of scrap copper through countries including Canada, Mexico, and Vietnam in a risky move to avoid 10% import tariffs, according to people familiar with the matter. That 10%, that's the tariffs that the Chinese placed on our copper scrap. The rerouting underscores growing stress building up in the global metal supply chain due to the trade war between the U.S. and China. U.S. scrap is a vital source of raw material for China's copper smelters and refiners, which account for about half of the world's output of finished metal. Prolonged disruption to that supply threatens to ripple across global markets. Chinese imports of copper scrap from the U.S. have plunged this year, falling from 39,373 metric tons in January to below 600 tons in July, the lowest monthly total according to Chinese customs data going all the way back to 2004. So almost no copper shipping from the U.S. to China because of their tariffs. However, shipments from other nations have largely filled the gap. Since China's overall imports of 190,000 tons last month was little change from the start of the year, shipments from Japan and Thailand have more than doubled since January, while imports from Canada climbed 29%. And in a stunning coincidence, U.S. export data, meanwhile, shows that Thailand, India, and Canada were the top 3 destinations for American scrap copper in the second quarter. So it looks like we do it too. All right, we sell a lot of our copper scrap to the Chinese. China says tariffs. All of a sudden, the Chinese are buying their scrap copper from Japan, Thailand, and Canada. And who are we selling our scrap copper to? Well, Japan, Thailand, and Canada. Everybody does it. So that's kind of interesting. Transshipments for the win. I just want to say thank you very much to Evan Francis. Thank you very much, Evan, for supporting the channel. He says, my prediction is Powell is hawkish. I'm leaning that way too. He says, then Trump will be upset. Yep. And slap on more tariffs. Interesting. I'm not sure the tariffs necessarily is a retaliation at Powell, but I do think he's going to throw a fit if Powell comes out hawkish. He has been announced. He has an announcement at noon today that will be semi-tariffs of 100 to 300% potentially. Black Monday incoming. Well, if you're right about that, Evan, 100 to 300% tariffs on semiconductors would be the stuff Black Mondays are made of. That being said, there's always a but. There's always a comma after something like 100 to 300% tariffs on semiconductors. I guarantee you, if he does that, he will carve out NVIDIA. There is no way President Trump will intentionally deflate this AI bubble. He does not want this bubble to burst on his watch. It's not his fault that this bubble inflated on his watch, but he will do everything he can to avoid that price discovery. President Trump views the stock market as his report card. He just doesn't want it to happen. Case in point, they're allowing the NVIDIA to ridiculously violate export controls. I mean, that is a huge national security risk, and they're letting him get away with it. Why? Because he wants his stock bubble. So could he do it? Yeah, he could, but he'll probably exempt NVIDIA. And again, the whole tariffs thing in retaliation to Powell, I'm not sure I see the connection there. I think the easiest way to retaliate against Powell, if he comes out hawkish, which Powell should, by the way, in my opinion, be hawkish. But if he comes out hawkish, my money would be on Trump appointing a shadow chair to undermine Powell's authority and reduce his influence in the interim. Thank you, Evan, for supporting the channel and for the super chat. Uncle Fedster, what's going on, brother? He says, happy Friday, Jack. Same to you. Thanks for being a trooper this week, for having such a sore throat. You sound good. I appreciate that very much. It's not that bad. I'm not like, hacking up a lung or anything, but just every now and then I get that tickle in the back of my throat, and it's distracting and it throws me off. And well, thank God for the mute button, so you guys don't have to hear me cough on the air. So that's all I can say. Thank you, Uncle Fedster, for supporting the channel and for the good vibes. I appreciate that very much. Hey, and thank you, all you wonderful melon heads and you magnanimous melon heads on Patreon and YouTube. Thank you guys so much for supporting the channel. Links down below should you feel so inclined. Also, hey, don't forget that like button and that subscribe button, all that algorithmic stuff. It's really good for the channel. So if you don't mind helping brother out, thanks again for the super chats, guys. Appreciate the support of the channel. Also, looking forward to talking to you guys on Patreon and my YouTube magnanimous melonhead members at 2 p.m. Eastern time today for our weekly get-together on Zoom. I'm sure we'll have plenty to talk about after Jackson Hole. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.